Hello, happy Friday, and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
It's just a function of a lot of the problems they've had at Boeing over the last number of years. I think Boeing has really been sort of squeezing the union over the last bunch of years to try to improve financials. Boeing needs to give ground here, but the way I look at it is that Boeing needs the workers right now more than the workers need Boeing.
Technically speaking, Brad, they should be able to cut by 50, even at 75 basis points just on that real Fed funds rate tightening. They're going to go for 25, and they don't want to fall behind what they call the labor curve.
This is an exciting time in software. There's a lot of innovation happening. There's a lot of capital going into the space. You're going to start to see Adobe as one of the best ways to monetize AI investments.
We got 1 hour to go until the market close for the week, so let's take a look at the major averages. The rally is continuing here today. So we have seen, 5 straight days for the S&P 500 higher, the Dow, the S&P, and the Nasdaq all up. The Dow up by about 254 points, the S&P up 0.4%. And Josh, it's up on the week as well, poised for the best week since last November. The same thing is true of the Nasdaq Composite, up about 5.8%. And it's also interesting to look at the sort of 1 month chart here, going back to early August when we had that big drop that happened related to the jobs report. We've come back from there and then some.
Yeah, and we did get some more data today. Consumer sentiment slightly better than consensus. Economists pinning that on a few of the trends we talked so much about: falling gas prices, the recovery in the market, and also those expectations for a cut from the Fed.
Exactly, and there's still that debate over whether it's going to be a quarter point or a half point.
Which is amazing because I thought we had
alive.
settled. I thought we were settled at 25. But
It
then
seems
I don't know
settled.
if you saw Bill Dudley today, former New York Fed president, saying strong case for 50.
Strong case for 50. Interesting stuff. So as we look at the groups on the move today, as all of that is being considered, we definitely see some interest rate sensitive groups that have been doing well. One of them is utilities, up another 1.1% today. I also wanted to check on the week for the sectors here. Energy, the only group in the red. The XLK, which is information technology, tech, up the most, followed by consumer discretionary. That's been an interesting trade, but so too has the semiconductor trade. Semis really come roaring back this week.
And look at NVIDIA.
Yeah.
I mean, we talked a lot about that. That was CEO Jensen Huang come out and giving really what sounded like a confident optimism take on his latest and greatest chips.
Yeah, and maybe also investors who like NVIDIA were looking for some reason, some trigger to buy the dip in that stock. And
They were pretty beat up, some of these
that
names.
commentary perhaps enough. I mean, Broadcom, another big winner on the week here.
After
Those
getting
shares
shelled
up another
after
1%.
that earnings,
Right,
yeah.
so a lot of this is sort of comeback, if you will. But if you look at the Philadelphia Semiconductor Index that includes all these guys, it's up the most since May of 2023 this week. So really has seen this big gain on the week. And I'm just going to equal weight it just so we can see kind of how broad the gain has been. Only one stock in this group, or actually two, including Mobileye, down on the week. ARM, the best performer within the semis on the week, up 25%.
Wow, nice move.
Yeah.
Let's get more perspective on this. Stocks are poised to end the week on a high note as traders debate whether the Federal Reserve will cut by 25 or 50 basis points at its policy meeting next week. Investors now pricing in a 59% chance of a 50 basis point rate cut there. For more on the market moves, let's bring in Matt Miskin, John Hancock, Investment Management Co-Chief Investment Strategist. Matt, it's good to see you. So, I was talking to an economist this morning, smart guy, and he said his base case next week, Matt, I mean, he's still expecting you get the traditional cut of 25, but he said, you know what? Suddenly it's seeming like kind of a much closer call than it was, that maybe we actually do get a supersized 50. What are you looking for next week, Matt?
Our view is that we're going to get a dovish 25. So they do 25 and then they promise a lot more to come. The bond market is already pricing in 5 cuts by the end of the year, and that is a lot. I mean, you rewind a couple months ago, you would never have thought this much. And in this election year, before the thought was, well, it's an election, they're not going to want to change policy. Clearly, they're going ahead with it. The labor data is slowing. The inflation data is slowing. We're at the start of a rate cutting cycle. We want to get positioned for that, and we've got some great investment ideas for it.
Well, and I also know that you think that there can still be a soft landing here. There has been sort of increasing debate about that. But 3 things need to happen. Lay that out for us.
So first, the Fed has to cut aggressively. So the bond market has to be right in these Fed cuts, and they have to bring the Fed funds rate down a lot. The second one is initial jobless claims need to stay low. So the jobs market really can't weaken that much more from here. We don't want the unemployment rate going up much more. So we need the jobs market to stay where it is. And then finally, credit conditions need to remain calm and cool. So high yield spreads is the way we look at that. High yield spreads need to stay tight. But you have those 3 things over a course of a week like this, and markets love it. You saw the 2-year yields fall a lot. You saw the dollar fall a lot. That's going to help actually borrowing costs. It helps foreign revenues. So that actually was pricing in a lot more of that soft landing scenario.
Matt, let's say, so you're expecting 25 next week. I'm just curious. Let's say it didn't go that way. Let's say you did get 50. Would that in some way, would it reorder, would it reshape how you want to be positioned in the market if that happened?
So we don't want to lose the trees and the forests, or is it the forests and the trees? One of those analogies. But at the end of the day, it's just one meeting. It's just one cut. Over the last 3 cutting cycles, they cut 17 times. So we're debating 1 versus 2 on the first. Usually there's 17 of them. So the average decline in the Fed funds rate since 1950 is about a 5% decline. If that average held true this time, we'd be back down to 50 basis points. We don't think it's going to signal much in terms of that. Look, we're looking at utilities, defensive equities, healthcare. Frankly, quality stocks with high ROE have done well in cutting cycles. That would be technology stocks. You saw them come back this week. And then on the bond side, Julie, I know we've been talking about bonds for the last couple of years on this show, but they're really starting to work here. So those are kind of the key parts of the market we would focus on and gravitate to in a cutting cycle.
Well, and Matt, as you point out, we've also been trying to drill down with guests. Okay, the Fed cuts next week, then what? Which you're sort of outlining that there's going to be a lot more cuts that are coming. So some of those picks that you were talking about, what tends to happen, and what tends to happen overall for stocks over the course of that whole cycle? And is it just one trend, or are there sort of many things that you see happening over the course of that period?
Yeah, Julian, I'm going to start with something that's terribly uninformative in that it depends on whether or not we go in a recession or not. So you go back into all these cutting cycles, and if you don't go in a recession, it's great. Stocks actually rally. If you go in a recession, clearly that's a different scenario. Usually what happens, though, regardless, is the defensive parts of the market, the higher quality parts of the stock market take on leadership. So cyclicals, lower quality parts of the market underperform. And that is actually whether we get a recession or not. So we do like that kind of positioning. And then if we go in a recession or there is any type of contraction in economic activity, bonds are going to be a standout. So you could still see a double-digit return out of fixed income here. Over the last year, bonds are up 10%. We still could see that furthermore out of the Treasury market in the next 12 months. So we do want to have a decent allocation to that as well. But at the end of the day, cutting cycle, whether we get a recession or not, is going to depend on that soft landing bullets we highlighted. And we just want to position accordingly because lower rates mean better income opportunities. You got to take advantage of that now.
Matt, I want to switch gears a bit here. Gold, Matt, rose to another record high. I mean, bullion has just surged this year. I'm curious what you make of that move. What do you think the message gold is sending us here as investors?
Yeah, it has been a mixed message. It's complicated if it was like a Facebook post or a Facebook status or something, because you've got the yen rallying, you got gold rallying, you got treasuries rallying. Those are all defensive. Those are all things that would say, hey, there's something actually wrong here. And then you've got stocks rallying, risk on, and you've got high yield spreads really tight. So it has been mixed messages. We do like gold as a commodity. It isn't reliant on China growth per se. You do see things like Bitcoin
Oh, I think that, Matt, we're losing your audio a little bit, but Matt likes gold. I think that was the that's the summary of what I believe he was talking about. And gold is at a record today again, right, Josh?
Rose to another record.
So it's performed pretty well for people who have liked it. Here's another stock that's, well, I guess depending on where you got in, depending on whether it's performed well for you. Trump Media is the stock we're talking about. Trump Media and Technology Group, DJT. It's surging. Former President Trump spoke in a press conference today and said he won't be selling his stake. Now remember, the lockup period, which prevents insiders from selling shares, is set to expire next Thursday. So there's been a lot of talk about whether insiders, including Trump, would be selling their shares. He says he's not.
Yeah, and this name has been making moves because remember, Julie, it tumbled on Wednesday following the debate, and I don't know if that was folks, was that given instant analysis of who they thought won,
Right,
maybe?
right.
I don't know.
Well, yeah, it's been a proxy for his chances.
That's how it's worked. It has been sort of this proxy, this vehicle for, you're kind of betting whether Trump makes it or not to the White House. It rises on some events and then, does fall on others.
Well, I had to wonder, as he made these comments, what kind of regulatory force a comment like that has. When he says, I won't be selling my shares, what happens if he then does sell his shares? Well, and he didn't say, I will never be selling my shares. He didn't, I don't know, I didn't hear the full context of the press conference. Did he say, he said, people think I'm going to sell. If I sell, it wouldn't be the same. I can understand that, but I have no intention of selling.
So he doesn't need the money at this point, right?
Well, I mean,
that was the takeaway?
but he says, I have no intention of selling. Okay, but things change.
They do.
Right?
Life
Life
gets complicated,
As
All
we were just talking about.
On that note, we're just getting started here on market domination, but coming up, Jefferies hits Moderna with a downgrade as the company's plan to trim its R&D budget. We're going to have the analyst behind that call coming up next. Solar stocks getting a well-deserved boost after a rocky year for the sector. We're going to discuss what's driving that shift. And later, economists are taking a closer look at lipstick sales. We'll break down what the lipstick effect signals about the overall health of the economy.
It's time now for some of today's top trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance trending tickers page. One of them is Boeing. Boeing has hit yet another snag in its comeback, with 33,000 factory workers overwhelmingly voting to strike after they rejected the company's latest contract offer. The work stoppage will not disrupt commercial flights immediately, but it was expected to shut down production of Boeing's best-selling airliners. Ratings agencies have warned that a prolonged strike could lead to a ratings downgrade for the company. And joining us now with more is Tony Bancroft, Gabelli Funds portfolio manager. Tony, it's great to see you as always. You guys have a big holding in Boeing relative to your portfolio. So how do you view this news and how much of a risk it could be for Boeing?
Yeah, thanks, Julie. It's great to be back. With our GCAD ETF, commercial aerospace and defense ETF, we continue to believe in the secular thesis of a growth story of commercial aerospace, and Boeing being, a large participant in that. I think in the near term, this is definitely, there's a lot of volatility going on right now. This strike is made it unclear of the timeline to get the production rates back to 38 by the end of the year. But I think in the long term, I think this is going to be more of a blip. I think that CEO Ortberg realizes the severity of this situation and knows that he wants to get this put behind the company and get back to improving the production line and improving the supply chain and the quality of the jets.
Have you tried though, Tony, to sort of even roughly game out, estimate what the financial impact could possibly be for Boeing in all this?
I think it's hard to say, Josh. I think there's some expectations that it's about $100 million a day for Boeing. So and just based on previous strikes and the economic impact on the loss of production over the tenure of that. I think the bigger picture is, I think that if this production, the story for Boeing right now is getting the production, the 737 production line back stabilized and growing. And I think overall, that's by far the most important thing that needs to happen. And I think he's fully aware of it. And I think he's going to be going to the negotiating table right away. And hopefully they'll come to an agreement very soon.
Tony, in the meantime, the ratings agencies, as we mentioned, are threatening downgrades here. The company has about $45 billion in net debt. If it gets downgraded, what are the ramifications of that?
Yeah, this morning, the CFO Brian West talked about the implications of stabilizing sort of production rates, and then when we get to that point, looking and seeing what it needs to be an investment grade. So I think that that bogey is out there. That there's a scenario where they would have to. That potentially could happen. I don't think obviously they want that. I don't think the market particularly wants that, but that might need to happen. But I think in the long term, getting the balance sheet healthy and not essentially walking a thin line with the balance sheet and working capital, I think that will be beneficial to Boeing. And the best thing they can do right now is get the production in line and start that growing again and getting it towards 38. And then hopefully the FAA will lift this 38 cap and we'll go from there.
Can I ask you, Tony, any thoughts on what a potential deal between Boeing and these machinists could look like? Any thoughts? What could they agree on? What you could get the two sides to shake hands on and move on?
I think the biggest sticking point was by far from all that was essentially the feedback has been speculated was the wage increase. That 25% was not the right number, obviously, and I think that's where the rubber will meet the road is getting that wage increase. I'm not sure if they'll get to 40%, but there's probably going to be. I think in the reality, I think that 25% was sort of the starting point. That's where negotiations began, and now there's opportunity for to arbitrage this and go with and go from there and come to an agreement.
If it was approaching 40%, would that be a problem for Boeing's already stretched profitability here, Tony?
So there's again, it's sort of I think it's estimated that it's about the touch labor is about 5% or so of the commercial businesses cost structure. So overall, it's not a large piece of their costs. And I think that some number inside of that 25 to 40% is probably going to get it over the finish line. And listen, the worker, the union, machinist union makes great planes. Boeing makes great planes. And they're, the secular story is that there's, essentially 10 plus years of backlog. Boeing itself, the commercial business, has almost $500 billion of backlog on its, on its books. And the airlines in the commercial aerospace industry need these planes.
Tony, good to have you on the show. Thanks for joining us. Have a good weekend.
Thanks.
Bad news for e-retailers like Shein and Temu. The Biden-Harris administration cracking down on a popular loophole used by Chinese retailers. And joining us now with more is Yahoo Finance's Brooke DePalma. Brooke.
Yeah, good afternoon to you both. It is a crackdown on the de minimis exemption. Say that 3 times fast. It allows items that are $800 or less to be imported without tariffs. And that's exactly what Shein and Temu have been doing. Both of them have been able to ship packages directly to U.S. consumers without having to pay these tariffs. Now, Yahoo Finance did reach out for comment on both Shein and Temu. Both companies really said that it is their mission to make affordable prices for consumers and also ship products efficiently. Now, this is a much bigger issue beyond just these 2 retailers that are really in headlines today. The administration saying that over the last 10 years, the amount of shipments that have used this loophole has grown from 140 million to 1 billion over the last 10 years. But we do see stateside some retailers getting a bit of a boost today in the stock market. Etsy up nearly 7% as we approach the close, because there really is optimism that should a crackdown go into place, then perhaps Etsy will get a bit of a boost as consumers look for other ways to shop online or other retailers.
Yeah, and I saw some other analyst chatter that even some of the dollar stores might stand to benefit from all of this. Meanwhile, U.S. companies are also preparing for the possibility that there could be more tariffs after the U.S. election. What do we know right now?
Yeah, exactly. A possibility, a case scenario, depending upon who wins and how it all plays out. But really what we're looking at here is former President Trump has floated around the idea of a 10% tariff on all imports and a 60% tariff on Chinese imports, whereas Vice President Harris is expected to continue Biden's approach with targeted selective tariffs. And what we're really hearing is that over the past few years, since that 2018 trade war, these sort of tariffs that have been in place is affecting U.S. households between $200 and $300 per a year. Now, other economists are predicting that should Trump go into office and should he implement these universal tariffs, that could cost American families between $2,000 and some economists even predicting as much as $4,000 per year. But once again, just a case scenario that retailers are potentially preparing for. And ones that I've spoken to have said they either have 2 ideas here. They either are going to have to raise prices for the consumer, or they have been diversifying their supply chain over the past few years. Skechers CFO saying that their goal really wouldn't be to raise prices, but they might have to. We also heard from Shark Ninja that they have been, over the past 5 years, diversifying their supply chain, and they did say that they have plans to ultimately create all of their production outside of China by 2025. But then we also hear from Urban Outfitters, who said that they plan to decrease their exposure to China with only 10% of their production here. So lots of retailers trying to figure out these case scenarios, but ultimately at the end of the day, the consumer might be pinched in the end.
Okay, we'll see what happens. Thanks, Brooke, for laying it out for us. Turning to U.S. Steel now, the White House officials signaling a delay in their takeover decision for the company. That's according to the Washington Post. We saw U.S. Steel shares pop, although then there were some reports that there hadn't been a change of plans, that's what the reaction from the White House was. So the shares had popped about 5% and then now up about 4% or so.
Yeah, we talked about, Julie, how this has become such a hot button political issue in this campaign because the United Steelworkers Union opposed, don't want foreign ownership. The company has shot back. Listen, plants could be shut down if we don't get this sale done. They emphasized, the billions of investment, the deal would bring. We had Barron's Al Root on recently, and Al's been covering this story, and Al kind of summed it up. His take was good politics, bad business. That's how he said this.
Well, and the White House has said it's waiting for the CFIUS decision. That's the body that decides whether the deal can go through. The deadline for that is September 23rd. So if it doesn't come by then there could indeed be a delay in that decision. So we'll see what happens.
All right, moving on. Take a look at shares of Adobe here, down in today's trade after fourth quarter guidance did fall short of expectations. Analysts calling the forecast disappointing. It looks like investors feel the same way. 8% in today's trade. And investors have these continued questions about AI monetization here. What do bulls say on a day like this? Brent Till over Jefferies, we know Brent well, told his clients, still a buy in the name. Says, listen, these were strong Q3 results, and as for what's ahead, continues to bet 2025 could be the year of AI monetization, so he stays a buyer.
Yeah, I mean, Keith Weiss over at Morgan Stanley is an overweight. He called this disappointing as well. Keith Bachman at BMO is an outperform. He said it was disappointing too. So there seems like a lot of disappointment to go around, especially for a stock that's already down, well, including today, it's down about 10% on the year, has not really participated in the AI upswing. Still, though, there are 35 buys on this stock.
Lots of love on the street.
Yeah.
All right, let's move on. Moderna pushed back its break-even goal by 2 years on Thursday, predicting 2025 sales below its forecast for the current year and delayed the timeline for developing several key products. Today's shares are close to a 4-year low. And our next guest slashed his rating on the vaccine maker to hold from buy. Joining us now is Michael Yee, Jefferies biotech analyst. Michael, great to see you on set.
I know, very
exciting.
Great to be here.
Let's just start there. So you do take the rating down to a hold, Michael. Explain why. Explain the downgrade.
There were two huge concerns that happened recently at Moderna. The first was that they lowered guidance for 2024 on COVID and RSV to areas that both have been disappointing. The scripts for RSV very, very low versus expectations. And the second thing that just happened this week, which really caused a lot of concern for us, is that they pushed out the profitability break-even point for this company, which is burning billions of dollars per year, to break even from 2026 to 2028. That's a far way out. So two things are going to occur. One is that they are going to burn a significant amount of cash in that time point. We're calling for the potential risk of needing to raise capital. Can you imagine this is a company that's doing $20 billion a year in COVID, and now we're talking about having to raise money. And the second is that we believe there's concerns over some of the projections as relates to the pipeline, and so we just don't think that that revenue or break-even timeline is possible. We think they're going to have to raise money.
When it comes to the pipeline, the idea, of course, was, okay, once we figure out that the mRNA platform works, we should be able to apply it to all kinds of things. That was the promise of this. Why is that promise not being fulfilled? Is it just that it's hard to do that it takes a long time, that COVID sort of fooled us into thinking it was quick and easy?
I think there's, on one, I think that we can agree that mRNA technology works. They obviously have the COVID vaccine approved. They now have the RSV vaccine approved. And I will even go on record to say it's very possible that the CMV, another virus, particularly that can affect babies, may have positive data in the next couple of months. So we know it works. I think that where we know is that it's very good for respiratory vaccines and preventing, obviously, respiratory diseases, but that's a very competitive space. They're not the only player, and obviously part of the issue here, particularly with RSV, is that they were not able to hit any of the sales projections. The pricing went down for COVID. So this is a tough space where the technology works. It has not yet fully played out for orphan diseases, and you might mention cancer. What happened to the cancer vaccine with Merck? That does look promising. However, they announced yesterday that although they had promising phase 2 data, they're not going to be able to file that drug until a few years down the road, until finishing it. And contrary to expectations, the FDA pushed back and said, we want you to finish a phase 3. So we think it works, but things have been pushed out and they are spending way too much money. That is the problem. The revenues do not match the expenses. They are burning the cash. And like many companies, sometimes I think EV companies or whatever we're talking about, they really need to adjust it. We need to really adjust to the post-COVID time. So
when you talk about these challenges, Mike, it sounds daunting. I'm curious what stopped you from doing a double downgrade to go to sell? Because some of your colleagues on the street, I saw JP Morgan cut to underweight.
Yes, there was a double downgrade today. There was another downgrade to hold. I think that on one hand, you do already have a significant pullback in the stock. It went from about 50 billion to 25 billion in the last couple of weeks or month. And so at 25 billion, a lot has been sort of priced in. I know the stock is only down modestly today, and so our call is more 12 months, we're going to see some more problems. And then also there is this potential for the CMV vaccine, which is going to have positive phase 3 data coming up. So I would just say that we definitely have some structural concerns over the medium to longer term. In the short term, a lot of the pushback today has just been, look, the stock is down a bunch, lots already been priced in, et cetera.
Can I ask you, though, about that stock? Because it is down about 40% now, Michael, in the past 12 months. Do you think this company has the right leadership team in place to navigate the kind of challenges you're outlining here?
It's a fair question. I used the word credibility in my last earnings note. In the analyst event yesterday, we did say there is some guidance credibility and management credibility issues that I think not just me, but Wall Street obviously is reflecting. And no one generally believes their forward guidance. And that's probably a credibility thing. So I do think that's a fair question. I will leave it to other people to push harder on that, maybe shareholders, to call further aggressive change. But it's a fair question.
Well, lest we leave people just with sort of this heavy weight of Moderna.
A little bit depressing.
Let's talk about something that you like.
Yes.
Gilead, which also had some data this week, had HIV data, had obesity data. How should folks be thinking about Gilead?
This is the opposite. So here we raised the price target a week and a half ago. We're at $95. We're extremely excited about what's going on Gilead because this is a stock where over the last few years hasn't done anything. Pull up the chart. Hasn't done anything. It's depressing. You might even remember this as the Hep C company. And so over the last few years, they've been doing well on HIV. They made a couple acquisitions. They haven't been so good. The stock has been basically bouncing around, and it's been a bit of a forgotten child, certainly relative to obesity names like Lilly and Novo and even Amgen, which we might hit on. And so the reason why we're excited about Gilead and when we think the stock is going higher is because they have announced this week and a second positive phase 3 study for a new HIV prevention drug called Capsid. And with a twice-a-year injection, one jab every 6 months, you can prevent HIV. And so people who are on PrEP, which is daily pills for the prevention of HIV, fully approved in America, does about $2 billion a year in high-risk individuals, can now convert to a very simple, easy-to-administer drug with 100% prevention of HIV. That's great. It could be multi-billion TAM. That's going to take a very sleepy story, could grow revenues by a couple $1 billion. That's nice on a stock that's down and out. The second reason is because they do have treatment of HIV. They're going to take treatment of daily pills and now convert it to twice a year injection. That could be $10 billion. So we're taking a very cheap stock, very down and out, very low expectation, no pipeline, and now they have a new layer to that. They should talk about this at an analyst event, first analyst event, I think in 5 years for Gilead. So I think people are catching on this. You mentioned obesity. They do have a GLP-1 oral that has now started phase 1. Let's watch that. That's certainly not in valuation either. So a lot of very low expectations on the pipeline, but yet some positive things coming up. So this is why you want to look at stocks that are down and out and positive things going on here.
You mentioned GLP-1s. I got to ask, Michael, if that trend is hot as ever in your opinion, and what are you telling clients continue to be the smart ways to play it?
Look, I think that we are in the 5th inning of a 9-inning game. Obviously, we had the early move maybe 2.5 years ago on Novo. Last year, we had the Novo Select outcomes data. Obviously, Lilly, I think, has doubled since then. And now we have cycle 3, which is you have about 27 other companies that are in this game. So I think everybody kind of knows and has heard about GLP-1. That doesn't mean that there's still select stories like Amgen, which trades at a 15, 16 multiple. If they really do have positive data at the end of this year and go to phase 3 like we think they will with a monthly injection, not a weekly. That can play in it. There's smaller companies with oral GLP-1s or others that can play, and certainly we do believe that pharma is still going to do some consolidation, M&A, and there's still pockets of areas there. So we still believe that certainly Lilly is in leadership position. We think there's room for others in a huge market, but you probably have to be more selective, and it's not just like everybody just goes up anymore. Yeah.
Michael, come visit us more often. It's
We're here. Let's do it.
Nice to have you in the studio. Really appreciate it.
Fantastic.
Good to
Thanks
see
for
you.
having
Thank
me.
you.
Yep.
Well, one final ticker check for you. We have to take a check of shares of Paramount Group. Now, this is a real estate investment trust with properties in New York City and San Francisco, and those shares are edging higher even after the company announced it's suspending its dividend in order to, quote, fortify its balance sheet. That dividend was set to be paid on October 15th, and earlier today on Yahoo Finance, we said and showed shares of Paramount Global. Well, coming up, solar may prove a winner if Wall Street's reaction to Tuesday's presidential debate is any indication. We're going to break down the latest moves in the sector on the other side of the break.
Now let's get to some calls of the day, sponsored by Tasty Trade. Stifel raising its price target on Unity software from 20 to 25. The note highlighting the company's reversal of its controversial runtime fee. So by way of background here, what Bloomberg points out, Julie, company reported plans, I guess, to change its pricing model, including canceling the so-called runtime fee for games customers, reverting to a seat-based subscription model. Unity Pro subscription prices are going to increase 8%. to $2,200 annually per seat. Unity enterprise prices go up 25% effective January 1st. Stifel analysts dug into this, obviously like what they saw.
Yes, and one of those analysts was over at Stifel here, or you just said Stifel, never mind. It's my brain on Friday.
It's fine.
I thought what the analyst J. Parker Lane wrote was interesting here. And by the way, this all seems to be a positive referendum on the relatively new CEO, Matt Bromberg, who is the one who made this decision. So as Lane writes, the company's announced runtime fee certainly seemed to be an opportunity to take more price as customers find success with games created in Unity. But he says the reputational juice was seemingly not worth the squeeze for the company. In other words, the runtime fee was bringing it more in, theoretically, to the door of Unity, but it made everybody mad. So then they got rid of it, which he says is more straightforward, and it's good news.
Yeah, it says it allows the company to move forward and regain its status as a trusted partner to the game industry. Has not been easy being a Unity bull. Stock is down about 50% this year.
Yeah, it did rise almost 10% yesterday when they announced this, and then the positive reaction just kept coming today, and the stock continued to rise. On the flip side, we've got Barclays downgrading Garmin from equal weight to underweight. The note citing an overly extended valuation. And indeed, the note here from Barclays, George Wang, really is focused on the valuation part of the story, saying it's valued at a premium versus what we've seen historically. The stock is up something like 30% year to date, even more before today's declines, of course. And also, Wang is talking about limited visibility into 2025 because underlying consumer hardware spending, that overall environment does remain muted.
Yeah, analyst says Garmin is not immune from COVID normalization, inventory overhang, weakening consumer spend, which may pressure margins. Also, he told his clients he sees increasing competitive threats from the Apple Watch Ultra, says that may temper the higher margin outdoor segment's revenue and earnings. So some competitive pressure there as well. Yeah. All right, big event next week, the FOMC's interest rate decision for September. Wall Street will be closely watching to see if the Fed does go cut by 25 or maybe 50, but how will that affect a rate-sensitive industry like solar? For more on how investors should be looking at the space, we're bringing in Maheep Mandloy, Mizuho America's Director of Clean Energy Equity Research. Maheep, good to see you. So let's start right there. Obviously, all attention is on the Fed next week, Maheep, and there's this debate we've had on this show between very smart people, whether it's going to be 25 or supersized 50. How does that event, Maheep, how does that impact your coverage universe?
Hi, Josh, and hi, Julie. And definitely, there's a nice transition from interest rates to solar, right? This industry is very levered. We've seen this industry react to any positive news on interest rates the last year, and we'll continue to see that going forward. Most of these companies do have almost 60-70% leverage or debt to capital ratio. There's definitely a lot of upside there. And then the two things to think about it. One is obviously on the fundamentals that helps reduce the interest expense going forward, but also on valuation. These industries generally get the growth multiples, which generally trend to do better in lower interest rate environments.
And the stocks, speaking of valuations, the stocks, at least as a group, have really come down quite a bit. Something else that is an upcoming potential catalyst is the U.S. presidential election, or at least it's perceived as such. We saw these stocks rally following the presidential debate. And again, this perception that if Kamala Harris's chances to become president are higher, she could potentially be more friendly to the industry. Do you think that that view is the correct one?
No, absolutely. And not just friendly, just keep the status quo of the Inflation Reduction Acts, right? And funny enough, was at a solar trade show earlier this week on Tuesday evening after, doing our meetings. Everyone was glued on their TVs just looking at the debate. And I think after later in the evening and the drinks and dinner, everyone kind of sighed and said, okay, yeah, sure, it looks like Kamala did slightly better, so that bodes well for all the renewable policies. But also President Trump talks about, he said he likes utility solar. He had caveats after that nonetheless, but still, he said that. And he did say he wants jobs over here, which also bodes well for most of our companies over here. So I don't think it'll be like a very bad news if Republicans or Trump come on in. I think we've said in our notes it's maybe at worst down 20-25% impact to our stocks. But definitely the business case or the status quo will be maintained under Kamala Harris.
Mahib, let's get to some picks too. I look at your coverage universe, a few different outperforms, Enphase, Sunrun, SolarEdge, Sonova. What about First Solar though? You're on the sidelines on that name. How come? And what do you need to see before getting more bullish?
Sure. They are the biggest beneficiary of the Inflation Reduction Act. They do get a lot of their earnings from these incentives. More than 60% of their EPS in our estimates for 2025 would come from these incentives from the Inflation Reduction Act. So there's a risk to those incentives. It's a non-zero risk, so we need to take that into account. And on top of that, you could see potential competition in the U.S. Later this year because of nearshoring, which will take 2 years to materialize. It takes at least 2 years to set up solar factories in the U.S. So I think that's the bigger question for investors. I think the near term or the next 2-3 years is already priced in. The question is, if competition comes up in the U.S. with new U.S. factories, what does that do to First Solar? And so we're on the sidelines on that, and we'll see what changes after the elections or potentially any new tariffs which U.S. imports against other countries.
Mahib, I'm also curious about U.S. penetration and adoption. We talk a lot on the show about the waning demand for electric vehicles. It feels like solar is sort of in a similar vein, but what have those adoption trends look like? Is it still as popular, I guess, with U.S. consumers?
It is. As in, if you look at the penetration rates for residential solar, we're somewhere around 5% of rooftops, of eligible rooftops are penetrated with solar. How fast this number grows, it depends on interest rates because most of the solar is bought on financing. But we think we can easily get to 10 to 12% later this decade. The challenges become in some states when it grows, say, more than 25-30% is when issues on which came up in California recently on the non-solar customer subsidizing the solar customer comes up. But I think that's somewhat of a issue later this decade or next decade.
Mahib, great to have you on the show. Appreciate it. Thank you.
All right, thank you. Take care.
Coming up, answers about the state of the economy might just be on your lips. Find out how the lipstick effect could be signaling a potential downturn. That's coming up next. Beauty is pain for beauty brands unable to keep up with the shifting retail landscape and the star power of social media. It is no easy feat to win over shoppers in the highly competitive beauty market, especially in an environment of price-conscious consumers. However, our next guest highlighting attractive plays for the beauty space and the risks hanging overhead. B. Riley Securities Senior Analyst Anna Glaskin joins us here to discuss. Anna, good to see you.
Good to see you too. Thanks
so
for having me.
before getting to what you like, I want to hear about what you don't like, because Ulta, you said that is a sell. And when you read through the notes, and I mean, there was different variables, but it sounded like a lot had to do with, you were seeing just competition, category deceleration.
Yeah, they're facing a lot of external headwinds. You've seen massive expansion of distribution in the category with the Sephora and Kohl's partnership, and you're also seeing a deceleration. Makeup and beauty performed really well out of COVID, much beyond what most people expected, and so now you're seeing a natural deceleration, and when you're a retailer facing these multiple headwinds, it could be tough to navigate. And so we think that those headwinds might not be fully appreciated in shares right now.
Anna, it's interesting that you're talking about this sort of deceleration, because we tend to think of the so-called lipstick effect, right? That if the economy is slowing down or even going into recession, people still buy lipstick or whatever beauty they want because it's a little thing that they can afford. The economy's slowing down. We might not be going into recession, we might, but how does that play into what you're describing?
Sure, it's a really common heuristic, and it's part of why beauty companies have been really well valued within the consumer space. I think a lot of investors look at the really resilient growth that the category has demonstrated. They think about the lipstick effect, and it does offer some defensive qualities. That said, I don't think that dynamic could really overshadow, things like market share losses, where it's not just a category issue, it's also a competitive landscape issue.
And I'm also curious how the rise of Gen Z and even Gen Alpha, people putting on makeup and skincare younger and younger, how that's affected the dynamic as well. We've seen skincare become even more important, so how's that all play into it?
Yeah, for sure. I mean, certainly the category has benefited from consumers entering younger and younger, and that's part of why we really like e.l.f. here. When you think about who's most willing to kind of cut back on makeup or skincare spend, clearly we've all been in high school. We know that, Gen Z or college consumers are less likely to want to sacrifice that. And I think e.l.f. really plays well within that cohort, and we expect them to outperform the group.
And why you look at e.l.f. though, Anna, it is down about 20% this year. Why is that? What have been the worries there?
So e.l.f., has had phenomenal growth over the past few years, and right now they're going through a deceleration. That said, they're still expecting double-digit growth in the back half. They're not growing 80% that they grew last year, so it's a deceleration, but it's natural coming off those highs. And I think as investors digest that dynamic, that's what you're seeing with the stock correction.
How important are beauty influencers to these brands at this point? And where does that leave an e.l.f. versus an Estee Lauder, for example?
Influencers are extremely important. I think the category really benefited from how well it plays on social media. The rise of the YouTube tutorial, I think, has been really key to the premiumization of the market, not just domestically, but globally. And I think that brands that are able to be nimble and catch on to trends are more equipped to really benefit from the influencer economy. And so I think e.l.f. has a really strong social media marketing team, and they're able to really latch on to trends and follow those. And I think being nimble is the new competitive advantage, whereas scale was the bigger advantage in the past.
So, Anna, we got a buy from you, we got a sell from you. Estee Lauder, though, you say is a hold. How come?
I think Estee Lauder is a bit unique versus the other companies we talked about that are mostly domestic, in that, Asia Pacific and travel retail has been a huge growth driver for them over the past, 5, 10 plus years. And so as we've seen a normalization of or pressure with the Chinese consumer, you're seeing less strong performance in travel retail. As they're navigating then the issues with the domestic market, it feels like even though earnings estimates have come down pretty meaningfully over the past year, they're down roughly 45% at the time that I initiated. It feels too early to try to call a bottom and say, here's where I think the pressure will ease.
Because it has been under a lot of pressure. The stock's really come down hard.
Yeah, of course, and clearly it's a battle-tested portfolio. It has enduring track record, of course, of being really strong. And so it's natural when you look at that chart, okay, it's down from these peaks. This might be really attractive. And we think that just at least for the near term, it's too early to say that those pressures have eased enough to get constructive.
And just real quickly, of course, they're also going through a management change. Fabrizio Freda, who's the longtime CEO of the company, is stepping down. Are you concerned at all about that shift?
I mean, opinions over the CEO turnover are mixed. Some people are saying, I'm excited for somebody new to come in. So that could be a positive catalyst. I think before the candidate or the next hire has been announced, it's a little too early to get excited about what that vision would be. But yeah, when you have, CEO and CFO turning over, in my eyes, that adds uncertainty to a stock that's already facing a lot of uncertainty.
Anna, thanks for coming in.
Thanks so much for having me.
Nice to see you in person. Appreciate it. Well, we're wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime. There's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. Let's get you up to speed on the action from today's session. We saw the rally continuing today, and a strong week for particularly the S&P and the Nasdaq, both of them having their strongest week since November. The Nasdaq Somehow I started here by accident, but it's up 2/3 of 1%. The S&P 500 up 0.5%, and the Dow up about 0.7%. But we did see, as I mentioned, that strong week for the S&P 500, up about 4% or so on the week. So definitely seeing some strength there. Should mention the Russell 2000 also having a strong ending to the week here. Interesting because it had been sort of lagging the other major averages. It looks like the equal weights also besting the S&P 500 today. So a broader rally than we have seen in recent days. One other standout that I just want to point out that we alluded to earlier in our conversation with Matt Miskin is what we've been seeing from gold prices. Gold ticking up again today to close at a record. Gold has really been gaining in popularity here. You know, we've talked to a lot of folks who have seen gold as something of a hedge here, or giving a little bit of defensive insurance, if you will. So that's part of what we're seeing here as we see that 4% gain over the course of the week. Elsewhere, in terms of sectors and areas that we're watching today, I wanted to look at this favored of our Jared Blickery, which is the sort of leaderboard, sentiment markers, things that are a little memeier, perhaps. And we're looking at a weekly chart once again. GBTC actually, big up performer on the week, the Grayscale Bitcoin Trust. ARC also rising here. So things that do tend to have a so-called higher beta that are seen as a little bit higher risk or speculative doing well this week. The SOX, we've talked about this before, the Philadelphia Semiconductor Index having a big week as well. The Magnificent Seven, or an older way to measure it, the NY FANG. So just giving an idea here that momentum, and there's even an ETF called Momentum, having a strong week here as we saw a little bit of juice coming back to the market. Of course, Josh, we'll see what happens next week with the Fed decision on Wednesday.
We will indeed, Julie. U.S. stocks ending the week on a high note. S&P 500 and Nasdaq notching a fifth straight winning session. Meanwhile, investors waiting in anticipation for the Fed's rate cut decision next week. With a 50-point basis cut back on the table, Eric Byrich, Sound Income Strategies Co-Chief Investment Officer, joins us now to discuss. Eric, great to see you here. So you think next week the Fed, they're going to do a traditional cut of 25, Eric. How come?
Well, I think the case for 25 is pretty strong. I think the case for 50 requires either more deterioration, and we're seeing some of that, but I don't think quite enough. But it would also signal that they're behind the curve. And remember, the Fed was behind the curve in raising rates. Now they don't want to appear behind the curve in cutting rates. And also, if you pay attention to their language, it was really only at Jackson Hole that they finally admitted that they needed to do something. There was plenty of evidence in the market that they should be doing something beforehand. So I just think out of caution and due to their nature, they're likely to just do 25.
Well, we were talking with a guest earlier, Eric, who talked about that it's not just about the first cut, of course. It's about how long they're going to be cutting and where they're going to be ending. And we're also getting the summary of economic projections, a.k.a. the dot plot, on Wednesday. What are you going to be watching for there?
Well, you know, we're going to see if the world lines up with our expectations. And we're thinking 25 basis points a meeting. You know, it's just going to creep along. Remember, the economy is slowing down, but it's not in free fall. So I think they can take back some of the short end of the curve, normalize the yield curve, reinstate the carry trade, and help everybody without looking desperate. And I think a 50 move would be a little desperate. So we'll, like everybody else, we'll pay attention to what they say and what they do. And we'll also look at the other economic data that come along with it. One of the common criticisms of the Fed is it's always looking backwards, and I think that's fair. So we also look at the incremental data. And we had some data come out this week. You know, you saw the CPI numbers, the PPI numbers, and so forth, and the sentiment numbers. And they're all like the typical sawtooth, a little put, a little take. But generally, the trends are in place. The economy is slowing, inflation is coming down, and jobs are weakening as well. So the Fed has all the ammunition they need to cut. And ultimately, that will either give us a soft landing, or if we have anything worse than that, it'll be very short-lived. One of the factors that we always talk about with people is that this cycle is different because normally a business cycle ends when you build too much capacity, and then you need to rationalize the excess capacity. Here we're having a slowdown still in an environment of shortages or dearth. So it's not a normal business cycle, and therefore we think the Goldilocks soft landing is really possible. Other people disagree. They look at the Psalm rule and things like that. this is really a unique time. The best parallel, if you want to look at history, is just the post-World War II era, when the economy repositioned from making war goods to making consumer goods, and there were significant shortages and high inflation as there was more want than there was material to serve it.
So let's talk more, Eric, about the stock market and the sectors you find interesting. You actually say the consumer sector is the most interesting to you here, Eric. How come?
Well, we should talk about all the sectors, but the consumer is very interesting because you have a clear disparity between the haves and the have-nots. So typically, you've seen some of the strong weaknesses in, say, the dollar stores or those that serve the lower end, and you've seen the middle and higher end hold up fairly well, which is ironic because the greatest real income growth was at the low end post the pandemic, higher wage growth, but they didn't have the savings. So all the savings got wiped out quicker. So as you have lower interest rates, that will make everything less expensive. And the combination of lower inflation and lower than wage growth, you'll have real incomes growing. So the combination of real income growth and actually a decline in money inflation will help everything, particularly capital goods and particularly housing related issues. So the consumer, which will most likely respond reflexively, will be the first area really going to see some turnaround. So some of the beaten down consumer names, usually you wait a year after they sort of bottom and before they really take off, and the stocks price things 6 months in advance, you'll start to see some strong consumer names and the ones that have been weak, I think, after the Fed puts a few cuts in the table.
And I guess you could call this sort of a consumer name. Perrigo is one of the stocks that you like here. Consumer in that it's a medical company, but it does make sort of consumer-facing products here. So talk to us through that one and why it appeals to you here.
Sure. So Perrigo is a great situation because it's basically they make private label personal care products. The company got caught up in the shortage of infant formula basically a year or so ago. So they ended up overmaking, and then you come off of that and the shortages, and then they have too much capacity and their earnings got waggled around. But looking forward, you have private label outperforming branded products as people try to economize. You have them getting this issue behind them, and they have pretty strong earnings growth and a high dividend yield. So that's what we look for. We look for value stocks with high yields where there's a catalyst for fundamental improvement. And Perrigo fits that bill. It's trading at only 10.5 times earnings. It has a dividend yield over 4%. And basically, it's supposed to grow its earnings by 25% next year, which is more than pretty much anything else in regular consumer that isn't a new product or new thing. And people just don't pay attention to it. They don't believe it. It seems sort of dodgy. And we like that. We're going to get paid a nice yield to wait. And if they just execute their plan, which looks very reasonable against easy comparisons, we think there's 50% upside in the stock in the next year, which is pretty high for, a sleepy dividend stock.
And another name, Eric, I want to get your take on Molson Coors. I know you like that name. You say extraordinarily cheap, Eric.
Well, the beverage stocks typically trade at 20 plus times earnings, and this one is trading at 10 times earnings. And it's got an over 3% yield. But the key thing with the stock is that, it's improving its margin profile. It's improving the value of its franchises. So they've been giving up volume. So the nattering nabobs that don't like it say, oh, their volumes are down. But that's intentional. They're giving up low margin volume and they're upgrading their portfolio. So they're selling off some, small brewage that doesn't do very well. And they got out of a Pabst Blue Ribbon outsourcing contract. So of course their volume is down, but their margins are up and their profits are rising. So they grew earnings last year, by 25+%. But going forward, it's just going to be a mid-single digit to high single digit earnings per share growth like the industry, but it's trading at half the industry price. And once again, it pays over 3% yield. So we really like it. And, it's one of these things where it's done very well for us. And we think it'll continue to do well as people come to realize that it's not going to give back all the market share it gained from Bud Light. That's sort of the cause celeb issue. Like, oh, it's only because they gained share because Bud Light reaction. Well, actually, they were doing better before that as well. So a nice situation.
Speaking of unloved, there's one more I got to ask you about, and that's Pfizer. And this is such a fascinating story. Obviously soared during COVID, has really come down here, has lost seemingly a lot of investors here. who are looking for the next catalyst and not seeing it from Pfizer. What do you see as the next catalyst for Pfizer?
Well, the catalyst is really twofold: executing on their cost programs, which they've been actually doing well with, and all of the pipeline stuff, at least the bulk of it, coming to fruition. The knock on Pfizer from this point forward is they took a lot of debt on to buy a bunch of portfolio products in oncology and in other, fat target areas, and they have a significant number of their core products coming off patent. They have $30 billion of their, $62 billion of revenues are going to go off patent in the next decade. So people say that's a big hole to fill. But if you actually go through, and this is more time than we have, all of the products and all of the formulas they have and the extensions that they have with the things that are going off, it's not going to be so bad. So I use the AbbVie comparison when they lost Humira, which was the biggest blockbuster, that they had, and one of the biggest of all time. And people said, oh, they're never going to be able to replace that, and they're going to see a spiral. And in fact, they did replace it, and they have earnings growth. And this, even though the multiple compressed greatly, and they had to do it through acquisitions, just like Pfizer did, it worked. So you're getting paid an extraordinarily high 5.8% yield. You have something that's basically trading at 10 times earnings. Even if it only trades up to 12 times earnings, you get 20% for that, and then you get, double-digit earnings growth. So, it's like all these high-yield value stocks. There's a reason that it's cheap, and then there are reasons why we own it, which is that we don't think that the reasons are fairly weighted. We think that they're overly bearish. And generally speaking, that works out if you're patient enough, or you say, we made a mistake, and you move on. None of these things, we have 35 stock portfolios typically. So none of these things are going to be such a massive weight that if patience is going to be too much of a drag, or, if we change our mind, then.
Gotcha.
But we own all three of those stocks. I own them personally. So that wasn't asked for the disclosures, but it's true.
Gotcha. Helps to be nimble, I guess, to your point as well. Eric, thank you so much, and have a great weekend.
You're welcome. You too. Thank you.
Thanks.
Bye-bye.
Shares of RH surged in today's session as customer demand accelerated. It's been one of the top trending tickers on Yahoo Finance. Danny Romero here with more on the luxury home furnishings retailer. I got to tell you, Danny, we covered the numbers when they came out last night. And I was kind of like, why is it going up so much?
Investors are really clinging to the shareholder letter, and that's really where the CEO, Gary Friedman, lays out that demand increased in the second quarter and also into the third quarter. Demand was up 12% in August, and product margins are positive. Remember, this is a company that did so well during the pandemic because of the housing boom. People were working from home, people wanted luxury home furniture, but that all changed from the pandemic to now. The company has had to adjust by releasing new products, planning to open new galleries here in the US and also internationally. They've also launched different source books. That's been something that's been really big and relevant for them. Overall, it seems like the makeover that they have been doing, it's working, and the appetite is back. And it's also important to note that RH did lower its full year forecast, showing that it is a difficult market, it still remains difficult, and the housing market hasn't rebounded either.
Right, so it's not as though it's 100% amazing. And it's also, Josh knows I love to look at short interest, 13% of the float is sold short. So maybe there's a little short squeeze happening too.
Could be. I think it's really just the whole demand.
Right.
That because that was said in the shareholder letter, that's what really the investors are clinging to. And also there is the potential possibility of the housing market to rebound too.
Yeah, we'll see.
Also, and we don't have time now, but viewers should check out Gary Friedman comments. Gary, always colorful.
Very colorful.
Yes.
Yeah.
Thank you, Danny. Appreciate it. Coming up with options expiration week just around the corner, an options trader revealing why she's zeroing in on some of the biggest Mag 7 names. That's next on Market Domination Overtime.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Months of speculation on the Federal Reserve's September decision on interest rates is nearing its end as the central bank readies to provide its verdict on a rate cut. We're taking a look at the peak of Fed speak with Yahoo Finance's senior columnist, Rick Newman. Rick.
You say it so much better than I would say it, Josh. Peak of Fed speak. So I'm just glad we're finally going to be able to start talking about something else. And you guys, not I, you guys are the anchors who have to ask people on air literally every day, when is the Fed going to cut interest rates? How much is it going to cut? As you just did with the prior guest. I mean, we have talked so much about this during the last 14 months, and that 14 months is the period since the last Fed rate hike in July of 2023. I actually added up how many times Federal Reserve policymakers, the FOMC members, have given public speeches or interviews or something during that time. It's like 300 appearances by those guys. And every time one of the Fed policymakers speak, every Wall Street bank, every forecasting firm, they all publish a bunch of analyses saying, here's what he meant, here's what she meant, here's when it's going to happen. No, the inflation data looks different. So thank God we are finally getting to the pivot. And I guess instead of saying, when is the Fed going to start cutting interest rates? Now we're going to be asking everybody, how long is the Fed going to cut interest rates? How low is the Fed going to go? But at least it's a different conversation. By the way, important implications for the election also. But I feel like I've already spoken too much about this.
We love asking people this every day, Rick.
stand corrected.
And it's funny because most of the time when you talk about the Fed pivot, or when people talk about the Fed pivot, they're talking about the policy pivot. You're talking about the pivot, right? Like that.
That's right.
That it turns to something else. But it doesn't seem like we're going to be talking about the Fed less.
Well, maybe we are, because we're going. I mean, so the pivot is important in itself, and that's really the thing. When is the Fed going to move from tightening to loosening? And we now know the answer. The Fed is going to move from tightening to loosening on September 18th, 2024. So now we will be in a loosening cycle, and that is. I mean, markets have been anticipating this for literally 18 months. I mean, we have seen gyrations in the stock market when inflation data comes out literally for the last year and a half, because the guess is inflation cooling more than expected, which means we get sooner to when the Fed is going to pivot. I mean, remember at the start of the year, we thought the pivot was going to happen in like April, May, or June. And then we went through several months of massive disappointment. Inflation was hotter than expected. So now we're finally there. So now, we're turning the plane around. And now we just have to go in one direction, which is a little bit of a different thing. So, by the way, I do anticipate that when the Fed does cut next week, as we know they're going to do, Donald Trump is going to complain. He's going to say the Fed is trying to put its finger on the scale for Kamala Harris, which is not the case. A quarter point rate cut is not going to put massive amounts of money in anybody's pocket, but it is going to signal now we're on the descent.
But do you think, Rick, to that point, I mean, Jay Powell emphasized repeatedly, of course, they are apolitical. But do you think he feels like, listen, he really could do 50 during an election year just weeks before the big day?
Absolutely not. I think this talk about a 50 basis point cut is ridiculous. It's completely unwarranted by the economic data. I mean, when people say that would look panicky and it would look political, I think that's spot on. I think there is, basically a 0% chance of a 50 basis cut for that reason. I mean, they've said all along, data dependent. The data now says now is the time to do it. Maybe earlier would have been the time to do it, but it's undeniable that now is the time, I think. And they're just going to do it gradually. We don't need anything more than gradual cutting for the foreseeable future, and that's what we're going to get.
Indeed. Rick, thanks a lot.
You're going to hear about it from me, I hope.
Well, we're going to talk a lot about it.
Other people.
Rest assured, we will be covering it thoroughly. Thanks a lot, Rick.
I know
Have
you
a good
will.
weekend.
See you guys.
Well, markets making a comeback this week thanks to tech and chip stocks. Our next guest, though, notes part of the moves are a result of short covering. It's time for the Options Playbook, sponsored by Tasty Trade. Joining us now, Danielle Shea, Simpler Trading VP of Options. Danielle, it's good to see you here. So you have been looking at the put-call ratio. How many puts are there to how many calls overall in the market as sort of an indicator of giving us some idea of the underlying technicals of the market. So what is it telling you right now?
Well, the most important thing this week was it got extremely elevated. Before we rallied about 1,000 points in the Nasdaq, we had the put call ratio up above 0.9. Generally, you want to see it about 1.0 for us to see a decent short covering rally, but this time it was enough. And so when we hit the low, that's where we had that high put call ratio. Ever since then, every day this week, it's been going down and going down as traders are covering. So, that helps with that upside pressure. At this point, it's actually getting low again, which is not great if you're long. Now we're getting down into the 0.6, 0.7 range, which basically means that the shorts have covered. But what's great about this rally is that short covering rally has sent the Nasdaq high enough that we've broken through a lot of resistance. So what that means is that the rally can continue even though a lot of the short sellers have covered.
And Danielle, you point out you usually trade the Mag 7. How come, Danielle?
Well, I love trading these stocks because they have weekly options, they have high liquidity in the options market, and they also have the great ability to trade them with spreads due to the high liquidity. So, when I'm looking through my options chain, I can identify pretty clearly which strikes have a lot of high open interest and high volume. And what you'll see with the Mag 7 in particular is that those stocks tend to land pretty close to where their high volume and open interest is on a Friday. And that's especially true on a witching expiration and a monthly expiration, which is coming up next week.
So then how should people think about positioning themselves going into that expiration week? If you take one of these names in the Mag 7, for example, just as a test case.
Of course. So first of all, you need to determine direction, right? Because you can have high open interest both above and below the market. And so the first piece of that is looking at the trend of the market and saying, okay, which direction do we think these tickers are going into options expiration? Now, because, for example, we've broken through a lot of resistance this week, and a lot of the Mag 7 have recovered up above resistance zones, I'm going to be betting on the long side. Now, could that change if it reverses earlier in the week? Yes, it could. But for the most part, what I do is I look at the Mag 7, I look at the expected moves in the options chain. So for example, with Microsoft, you're going to have about a $10 to $11 expected move. You're trading at about 430. 440 is the next key psychological value. That's also overlapped with another zone of resistance. And you have a lot of high open interest there in the options market. So 440 would be my next target. And then a little bit higher is going to be 450. Now that's really the key psychological value. But it's a little bit out of the range as to what Microsoft could hit next week. So typically in options, I'll use something that I call the easy target, which is going to be the lower price target, which would be 440. And then the extended price target, which would be 450 in case we get a greater than expected move.
And Danielle, are you trading NVIDIA here as well?
Oh, yes. I love trading NVIDIA, and I love the way that NVIDIA has rallied off of the lows. That is incredible, the strength that we've seen there. And I want to point out that we have a ton of high open interest at the $130 strike price in NVIDIA. And so when you have that volume and open interest, it just tends to act as a magnet. So when you combine that with the fact that it's recovered incredibly well, it's broken through resistance, we have this nice uptrend, that means that 130 is going to be my next price target in the options market. So, you can do something like a butterfly. I love butterflies because you can get into them for a relatively cheap debit. You can also do call debit spreads. I prefer those over trading just straight long calls. I know a lot of options traders like long calls, but when you have those high open interest targets, they're a great spot to throw a spread on.
Danielle, great to have you on the show. Enjoy the weekend.
Thank you. You too.
Time now to watch next week, starting off on the Fed. Some say the first cut is the deepest, but we're going to see next week whether the Fed's potential interest rate cut is 25 or 50 basis points. FOMC's interest rate decision for September is on Wednesday. We're also going to get an updated dot plot from Fed officials. After the decision, Fed Chair Jerome Powell holding a press conference at 2:30. Yahoo Finance's coverage on Wednesday will start at 2 p.m. Eastern.
Also, we'll have some headlines on TikTok. The U.S. Appeals Court is hearing challenges to a potential U.S. ban of TikTok on Monday. TikTok's Chinese parent company ByteDance is challenging the ban that was signed into law back in April. The law requires ByteDance to sell TikTok's business in the U.S. or face that ban starting on January 19th.
And moving over to the economy, we're going to be getting monthly U.S. retail sales on Tuesday morning. Economists forecasting a 0.2% decrease in the month of August.
And finally, some more corporate earnings coming in. General Mills, FedEx, Lennar, and Darden Restaurants will all report throughout the week. That'll do it for today's Market Domination Overtime. Did we even talk about that it's Friday the 13th very much today?
I don't think so.
We did the whole spooky thing yesterday.
We didn't want to jinx it. We didn't want to jinx it, and you just did.
Oh, sorry. We'll be back on Monday, 3 p.m. Eastern, for all of your coverage leading up to it after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Ask Me for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. The S&P 500 and the Nasdaq capping off their best week of the year. This rebound rally driven by chip stocks, which were some of the top performers this week. Meanwhile, Uber, one of the big movers on Wall Street today, the company expanding its partnership with Waymo, offering driverless rides now in Atlanta and Austin. A look at what this means for the robo-taxi space straight ahead. Plus, consumer sentiment rising in the latest reading, but one of the key issues for people, grocery prices. To get a deeper dive into how shoppers are spending in our chart of the day. Waymo's Jaguar EV robo-taxis will soon be part of Uber's fleet in Atlanta, Georgia, and Austin, Texas. The two companies making the announcement Friday, expanding a partnership that has already been Alphabet-owned Waymo's autonomous vehicles, fulfilling over 100,000 weekly paid rides across Phoenix, Los Angeles, and San Francisco. It is currently unclear exactly how many Waymo robo-taxis are going to be deployed, but Uber says there will be eventually hundreds of the SUVs in Atlanta and Austin. And joining us now is Phil Koopman, Carnegie Mellon University Associate Professor. Phil, it is good to see you. So let's start right there, Phil, because this certainly got a lot of attention today. Uber expanding this partnership with Waymo to Austin, to Atlanta, made a lot of headlines. Just high level, Phil, what did you make of that news? What did you make when you saw that headline?
I don't think it changes anything fundamental about the technology. It's a business arrangement, and that's fine. But the real trend here is that Waymo is growing its fleet, and the question is what kind of growing pains they'll have as they start operating in new cities.
And what kind of growing pains would you possibly expect, Phil?
Well, we saw a lot of growing pains in San Francisco, and some of the things were things that safety folks like I hadn't really anticipated. So I expect more surprises. But to give some examples, there were a lot of incidents with interfering with emergency response equipment and firefighters and police scenes and things like this. There were cars blocking firehouse driveways. And that was not only Waymo, that was also Cruise having those problems. So the question is, what about these cities that will be different that'll cause problems? Now, I expect Waymo to pay attention, and I expect them to try and fix things. But we won't know what the particular problems are until we see them.
You know, Phil, you've been studying this technology for a long time, right? I mean, for the rest of us, you know, many of us are relatively new to see these vehicles on city streets. In your opinion, Phil, commercializing this technology here and now, does it make sense? Is it ready for that?
I have been doing self-driving car safety for more than 25 years. So this stuff has been around a really long time. Back then, it was a college experiment kind of thing that some of my colleagues did. I think that the question always has been safety. That's certainly what people ask. You can have nuisances where the cars get confused and stop in the middle of traffic, and those can cause problems for cities. But the thing everyone's really asking is, well, is it really going to be safer than human drivers? And what the companies have been selling on is it will be safer in terms of injuries, severe injuries, and fatalities. They keep saying it will have fewer fatalities. And right now, if you look at the Waymo safety page, it's pretty readily interpreted to say we're already saving lives. But the reality is nobody knows how this will turn out. There just aren't enough miles to know whether they're saving lives or not. And it's going to take a few years to find out. So that's the big question. Is it really safer?
That's interesting because that is that's a key messaging that you hear, right? You know, we need this technology. This is a lifesaver. Your point is, you know, not to mischaracterize you, Phil, so I want to make sure I hear you right. We don't have enough data right now to make that claim?
Right. There's enough data now to know that small crashes, fender benders, and minor injuries, there's enough data to know that says Waymo seems to be on track for that. There's all sorts of discussions you can have about the data methodology, but right now, there's no reason to worry about the small crashes from what we know now. Maybe there's a change tomorrow that changes that, but for now, it looks okay. But they need another 10 times more miles, another 20, 50 times more miles before we know how it turns out for fatalities. And it's a very simple numbers thing. Waymo has something like 22 million miles last time they had a number. 22 million sounds like a lot, but in the US, a good round number is 100 million miles between fatalities, and you need much more than that to get statistical significance. So they need 20, 30, 50 times more miles before we have any way to know how fatalities will turn out. And I'm not saying anything good or bad. I'm just saying that it's too early to claim. You're running a marathon and you're 2 miles in, you're 3 miles in, your splits look good. It's too early to give yourself the gold medal. And so anytime someone says, we've already proven we're safe, we've already proven we're saving lives, they're giving themselves that marathon gold medal, and they're still back, they're only a couple miles in. Simple as that.
Phil, final question. We got a lot of investors watching this show. As you mentioned, you've been studying this area for a long time. Do you think robo-taxis are ever going to prove to be a profitable business model, Phil?
I have trouble seeing robo-taxis as a business model because it's a cheaper ride hail. And the technology is really sophisticated, expensive. It requires a lot of support. Now, maybe someday, never say never. But I find other business models such as middle mile trucking a lot more compelling. But we're going to see. I'm the safety guy. I'm not the investment guy. So we're going to see. The one thing that has been true for a decade and will be true for another decade is that scaling up will take longer than everyone wants to believe. The key limit to this technology is machine learning. The technology that's used is really bad at stuff it hasn't seen before. And the world is full of crazy edge cases, rare events. And that is why it's taken so many years and why it's going to take more years. So the big question is, how fast can they scale? And even at 1,000 robo-taxis, compared to the number of cars on the road, that's not many. So we don't know. We'll see what Waymo does, but keep your eye on how fast they can scale up.
We will. And Phil, it was great to have you on the show, helping us walk through a complicated topic. Appreciate it.
Thanks for having me.
U.S. stocks closed the week on a high note, posting strong weekly wins. Yahoo Finance's Alexandra Canal joins us now with the trading day takeaways.
Hi, Josh. Well, a big trading day takeaway for me and really the past 24 hours has been the shift in expectations when it comes to how aggressively the Federal Reserve is going to cut interest rates next week. It was only yesterday that the majority of traders were betting on a 25 basis point cut, but that has shifted pretty dramatically. We are now 50-50 when it comes to whether or not we'll see a more aggressive 50 basis point cut or that 25 basis point cut. Now, the reason for this is that we got two reports from the Financial Times and Wall Street Journal that policymakers are really having a difficult time deciding what to do here. We also heard from former New York Fed President Bill Dudley about how a 50 basis point cut, there's a strong case to be made there as the Federal Reserve works to really navigate a soft landing of the economy. And it's interesting to see how that's being reflected in markets. We're seeing this market rotation happening right now. If you take a look at the S&P 500 equal weighted index, that closed up nearly 1% ahead of all three of the major gauges. You look at something like the Russell 2000 small caps, a very interest rate sensitive area of the market, closing up nearly 2.5%. And then I also want to take a quick look at yields. The 10-year yields falling about 3 basis points to trade around 3.65%. Same thing with the 30-year, down about 2 basis points to trade just under 4%. And really, when we look ahead at what the Fed decides, I think we're going to see some volatility regardless of the decision. And that places that much more emphasis on that post-decision presser from Jerome Powell at 2:30. What is he going to say if we do get a 25 basis point cut? What is he going to say if we do get a 50? And is he going to leave the door open heading into the rest of the year?
Yeah, there's so many interesting wrinkles in this because I've heard very smart economists who want to say 50 say, listen, the federal funds rate has been around above 5% for a while to fight inflation. Inflation is now cooled. We need to focus on the labor market. At the same time, another thread to think about is, we were just talking to our own Rick Newman, politics. I mean, I know Jay Powell will tell you he's apolitical, but can you really do 50 in an election year just weeks before the big voting day?
Right. Earlier today, we heard from JP Morgan, Michael Feroli, saying that he hopes the Fed will do the right thing, which in his view is cutting by 50. So, it's going to be a toss-up to see whether or not we're going to see that. But another thing I also wanted to highlight when we think about the trading action that we saw is that tech is back, baby. I mean, we saw the Nasdaq having its best week of the year. And a lot of that has to do with the strength that we've seen seen in names like NVIDIA. If you take a look over the past 5 days at a heat map here, you'll see NVIDIA is up nearly 16%, along with some of those other Mag 7 names like an Amazon, Microsoft, Alphabet, Broadcom up more than 22%. And this follows a lot of positive commentary that we got this week from the Goldman Sachs Investor Conference. A lot of the leadership within the chip sector, including CEO Jensen Huang, really talked positively about the demand. And another story there is the hyperscalers and how much more aggressive they're going to be when it comes to spending on these AI chips. And don't forget, it was only about a month ago that we were at that August route, and now look at where we are today.
Yeah, Jensen Huang, I mean, really helping there, talking about his latest and greatest generation of chips. Blackwell, talking about strong demand. That really helped lift a lot of chip names. Also, to your point, though, Allie, a lot of these names have been really beaten up. I mean, yes. Broadcom reported and got slammed.
Right, and if we take a look at a longer term here, let's take a look at a 3-month here. You'll see the choppiness that we've still seen down roughly flat over the past 3 months. So we'll see how we can play out towards the back half of the year and whether or not we'll see some momentum. I think Q3 earnings, that's going to be really critical to see how some of these stocks can really sustain this recent rally, and a lot of that is going to have to come down to demand.
Yeah, you got another chip named Micron, memory chip giant, reporting soon, coming up later this month. Thank you, Allie.
Thank you.
Appreciate it. Coming up, a deep dive into luxury retail. Ever wonder why designer products are a bargain in some countries? We're going to break down how this price gap is fueling a booming resale market and why some brands are struggling to address the issue.
This is Yahoo Finance Invest.
Tapestry continuing its court battle with the Federal Trade Commission, the holding company for brands including Kate Spade and Coach, trying to acquire Michael Kors' holding company, Capri, in a deal worth $8.5 billion. For more, we are bringing in Pauline Brown, LVMH, former chairman and author of Aesthetic Intelligence, along with Yahoo Finance's very own Julie Hyman. Pauline, it is good to see you. So the FTC doesn't like this deal, Pauline. They don't like this merger. They say it's going to lead to higher prices. You agree with the U.S. government on that?
In this particular case, I don't. And I was surprised that they took action. I think the trickiest part of their legal argument is that there is a natural market, not for handbags, and not even for luxury handbags, but for what they're calling accessibly priced handbags, luxury handbags. And I mean, the reality is, I think it's a spectrum. and going to be, normally I would say once the FTC takes action, their probability of victory is pretty high. When I look at the facts here, I think this is a high hurdle.
As someone who is inside that world, what goes into figuring out how much a luxury handbag should cost?
Some of it is cost of goods. So the cost of goods of a Coach bag is considerably less than the cost of goods of an Hermes bag, and considerably more than a Le Sport sac. So there's always that variable. There is also where it sits on the floor, what the competitive market is, what the trends are. Every few years, a brand hits it right and is an it bag, and therefore able to have a lot more pricing power. But I would say in the case of Capri and Tapestry, and most notably Coach and Michael Kors, they have played pretty consistently in that bridge category in terms of their pricing, and that is because that's where they distribute in terms of the mid-tier department stores, and that's where they price it based on how much it costs them to make it.
And do you think that the FTC has a valid argument in thinking that customers will be disadvantaged from a pricing perspective if these two do complete the merger?
Right. So the assumption there is that once the two companies, which are the two largest in that particular segment, once they merge, that they will be in a position to raise prices and therefore harm the consumer economically. Do I think that if the quality of their bags is not radically improved, or the investment that they put in them doesn't change, that will in any way change their ability to control the customer behavior? No, I don't. I think the customers, if they're happy, they'll still come at the right price for the right designs, and if they're not, they're going to go to another player. So I think it's a feeble argument.
If the FTC does prevail here and blocks the deal, what effect does that have on consolidation within luxury, whether we're talking about handbags or clothing or beauty or whatever it may be?
Oh, I think, having been in the acquisition world for many years, I was a partner at the Carlyle Group, and then earlier than that, I had headed M&A at Estee Lauder, which was a very acquisitive time in Lauder's history. Of all the things that I weighed in terms of risk of doing the deal and risk of the deal turning into an accretive one, FTC blocking really didn't enter my consideration. It's not to say we didn't have to go through the protocols and that it was a no-brainer, but I would say relative to all the other risks, it was not a deterrent. I think it will add a very different consideration set going forward, especially among larger players that are, as they have been historically, looking to consolidate.
And Pauline, finally, I wanted to ask you about another handbag-related story that we're watching, although it's not unique to handbags. But we've been seeing this sort of arbitrage business that has sprung up with luxury goods, where folks buy the goods in Europe, for example, handbag made in Europe, at a lower price, and then resell it at a higher price in the U.S., in Asia. And that's been a growing business on the part of these third-party sellers. How is the industry viewing that, and what, if anything, can they do about it?
Well, first of all, the industry doesn't like it for a lot of reasons. The consumer loves it so far as the consumer is protected from the cheaper bags actually being counterfeit bags. And I will say counterfeits have become, especially in the accessory segment, so good that it can be very hard, even for a trained eye, to see what's legitimate and what's not. Of the legitimate products that are being resold for cheaper amounts, I think there's a few issues that have opened the way, or a few shifts that have opened the way for that new market dynamic. And some of it is the industry's own doing. In the last 5 or 6 years, most of the handbag companies in the luxury segment have gone up in price by an average of 55%. And when you take price that radically, you're basically telling the market, you're giving them a great incentive to find arbitrage opportunities. And there's always been a differential between how much a French bag costs in Paris and how much a French bag costs in New York, or even more in terms of even more differentially in Shanghai. That difference, though, right now is making it worthwhile for any middleman to buy and sell and capture the profit in the middle.
Pauline, great to have you on the show today. Enjoy the weekend.
Thank you. Good to see you both.
And coming up, we're taking a bite into the chart of the day, more asking for a trend right on the other side. In today's chart of the day, we're looking at grocery shopping and what people are expecting to spend at the market. Let's get to Yahoo Finance's Julie Hyman now with a closer look.
I mean, this was very much on my mind this week for a number of different reasons. One, it's a political issue, right? What people are spending at the grocery store is something that came up in the debate. Two, we looked at food at home prices, remember, as one of our charts of the day this week, following CPI that we have seen since before the pandemic. Overall CPI up 21%. Food at home prices up 26%. So it's very much something consumers are thinking about. Bank of America does a regular survey of consumers and tries to get a sense of what they're planning to spend on and how much they're planning to spend on. They did this survey of 1,000 people from September 9th to the 11th. And one of the things they look at is how much people plan to spend on groceries. This is looking at what they plan to spend 12 months out from now. And there is this divide between higher and lower income consumers. You've seen that it's kind of muddled along. The lower income consumers are the purple ones here, and they plan to spend less on groceries a year from now, whereas upper income consumers plan to spend more. There have been times when both of them plan to spend less, and there are a number of reasons behind this. One, it could be that people are still cutting back. Two, maybe they're hoping that prices are going to start to alleviate, although prices are probably not going to go down necessarily. They might just rise at a lower rate. One other thing I just quickly wanted to mention is we also got numbers from Kroger this week, a big grocery store chain, of course. Those shares went higher over the course of the week here after reported numbers. People buying more private label, AKA cheaper stuff, and their margins have been improving. Josh?
Thank you, Julie. That is a wrap on today's Asking for a Trend. Be sure to come back on Monday at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.